months ago, it's like conspiracy theorists. I saw headlines, conspiracy theorist, and and they told us back in October of 2 years ago, they said, oh, we're going to need these billions, these trillions to unfreeze mortgages. But the day after October 4th, Paulson said, we're going to spend it on something else. We're not going to tell you. Then they didn't even fix the derivatives problem. They took it as bonuses. And now here we are 2 years later. Let's go over what's happening in courts, why they're stopping many of the foreclosures now, why they're trying to get Obama to sign a law to legalize all this. Because I know most of the frauds at the institutional level and pension level, but individually, the 100,000 homes in foreclosure a month, according to the federal government, at record levels. What is, in the gamut, what are some of the most common frauds the banks are engaged in?
One of the first things they do is they convince the loan broker, the person who brings the customer to the lender, they convince him to breach his fiduciary duty to the borrower by lying to him and telling him that the property is worth a whole lot more than it is. And you tend to believe that because the appraiser will appraise it for a whole lot more than it's worth.
So there's systemic fraud.
Yeah, and the appraiser will appraise it for a whole lot more than it's worth because only the banks can hire appraisers by the bank's rules. This way they get to increase the initial amount of the value of the property. They get to increase the initial amount of the loan, and they collect fees at closing. If anybody has a loan here, you look at your HUD-1 settlement statement and list all the fees they charged you. Good portion of those are forbidden to be charged to you. They charge those to you, then take those fees, give them to the broker under the table. The broker who brings you the loan is only allowed to receive 1% of the principal of the note as a commission. That's so that everywhere the broker looks, everybody's going to pay him the same. However, the lenders are sliding the money under the table to get them to lie to the borrower and bring him a more expensive loan product. When they do that, then the lender can take the loan. As soon as you sign it, he's going to take it and sell it. He will receive consideration from the investor, but he keeps the lien. He'll sell the note. The note it's like a check. You write a check, that's a security instrument. You write a note, that's a security instrument that doesn't get collected all in one moment. It gets collected monthly over a period of years. Essentially, it's the same thing. So he takes that check and he sells it to the investor, but he doesn't give him the lien document, the document that is there to protect him in case you don't pay. And it took a long time to figure that out because the Supreme Court of Kansas addressed this issue, and they said, while you can separate these two, it's legal. But if you do that, then you've created a fatal flaw in that the guy who purchased the security instrument, he has a claim against the property. But no, I'm sorry, he has a claim against the signator on the note, the guy who signed it, but no claim against the property. The lender holding the lien, he has a claim against the property, but he received consideration. He can't be harmed. So the lien's void.
So that's how you have multiple banks coming after the same property.
Oh, they'll get, no, what the lender then did, the special purpose vehicle that purchased the note, he combined it into a whole bunch of different pools. Instead of one real estate mortgage investment conduit, he combined it into a whole bunch of them and sold them over and over again. So he got multiple consideration for the note. What we're saying is even if you didn't pay the note, and even if the payment is owed, the question becomes, who's it owed to? Who actually owns it?
So that's how they're taking houses that are completely paid for, because it doesn't matter, because somebody else can claim they have some type of ownership to it.
Exactly. We have a guy in California that Bank of America came and took his house. 2 months later, Chase came and tried to take his house. They all think they own it. They've sold it to everybody. But the question I had was, why would the lender keep the security, keep the lien, if it caused this much of a problem? He kept it because he'll hold it for 3 years, file a trustee IRS Form 1099-A, write it all off his capital gains tax as abandoned funds. He gets consideration a second time. And then once he sells the note to the investor, he becomes the servicer of the note. If you pay the note on time, he gets 3% of payment. Pay it late, he gets an extra 5. It is in his best interest to create a loan the borrower has to struggle to pay and regularly pays late. And if you default, he'll make about 50 grand on the default.
Opinions expressed by our numbers that grow may tell you some things that you don't want to know. You can say that we're crazy, you can call us a name, but unless you do something, the result is the same.